Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we are popping the hood on the economic engine of Europe, Germany. And honestly, it looks like they are trying to perform a massive repair job on that engine while speeding down the Autobahn at 100 miles an hour.
It's a high-stakes mechanical overhaul, that's for sure. I
Yeah.
mean, we are looking at a really pivotal moment in economic history here, in early 2026.
Right.
The decisions being made in Berlin right now aren't just about next quarter's earnings. They're about whether the entire German model can even survive the next decade.
So we've got a stack of new data and analysis on the table. And to keep this clear for everyone listening, we're going to break this deep dive into three main stories.
Okay.
First, Germany's new diversification strategy, which I know it sounds like corporate buzzword bingo, but it's actually a desperate attempt to break up with some old toxic dependencies.
Right. And then second, we have to look at the internal friction. The German government is basically screaming for safety and de-risking, while the biggest German companies are looking at their spreadsheets and, well, doing the exact opposite. It's a massive tug of war.
And finally, we'll tackle the second China shock. If you remember the early 2000s when U.S. manufacturing got hollowed out, this is kind of the sequel. But the plot is twisted, and the targets are very different this time.
And it's so important to set the stage here before we dive in. We have President Trump back in the White House.
Right.
And that has just fundamentally altered the calculus for trade and for security. It's the backdrop for everything Germany is doing right now. They are scrambling for what you might call geopolitical insurance policies.
Okay, let's start with that first theme then, the breakup. To understand why this is happening, we have to look at how Germany got so rich in the first place. For about 20 years, the German economy was like the envy of the world. What was the secret sauce?
Well, it wasn't magic. It was a very specific formula. We sometimes call it the three-legged stool. It was incredibly stable for a long time, but it relied on three external factors that Germany, couldn't really control.
Yeah.
Leg one, cheap energy piped in from Russia. That fueled all their heavy industry.
Got it.
Leg two, unlimited export growth to China. That's where they sold all the Mercedes and the BMWs.
And leg three.
Outsourcing security to the United States. Germany didn't have to spend much on its own military because, well, Uncle Sam was picking up the check for European defense.
Okay, so cheap gas, a hungry market for your cars, and a bodyguard you didn't have to pay for. I mean, that sounds like a dream scenario for any CFO.
It was a fantastic deal until it wasn't. In the last few years, all three legs just got kicked out from under them.
Oh, three.
We know about the energy crisis when Russia turned off the taps. Now, with the Trump administration, that U.S. security guarantee feels, let's just say, conditional.
Right.
In China, they went from being the best customer to the fiercest competitor.
So the stool just collapsed. The economy stalled. And now they're trying to build something new.
Exactly.
I'm looking at the reports on Chancellor Friedrich Merz's recent travel itinerary. He's not going to the usual spots. He's in Saudi Arabia, Qatar, the UAE. This isn't just for photo ops, is it?
Oh, no, this is business, urgent business. This is the core of that new strategy we mentioned. They are trying to replace that cheap Russian gas with LNG, liquefied natural gas from the Gulf.
But there's a deeper layer there, right?
There is. It's a return to what they call realpolitik.
Realpolitik. Okay,
Yeah.
we hear that term thrown around a lot in political science classes. But practically speaking, in 2026, what does that look like for, say, a German manufacturing CEO?
It means pragmatism over idealism. It means admitting that you can't heat homes with values. In the past, especially with Green Party elements in German politics, there was a lot of hesitation about getting too cozy with autocratic regimes.
In Gulf, yeah, because of human rights records.
Precisely.
And now?
Now, the survival instinct has kicked in. Germany needs energy security. The Gulf has the gas. So Germany is making the deal. We buy your gas, and in exchange, we offer what we have: defense cooperation, weapons exports, technology. It's purely transactional. Energy for security.
It feels like a massive pivot.
Yeah.
And you mentioned they aren't just looking at the Middle East, though. I saw Foreign Minister Johann Wadephul has been racking up frequent flyer miles in the Indo-Pacific, Singapore, New Zealand, and specifically Australia. So why Australia? It's a long way to go just to say hello.
It is, but Australia holds the keys to the next industrial revolution. We're talking about critical minerals.
Lithium, cobalt.
Lithium, cobalt, rare earths. You simply cannot build an electric vehicle, a wind turbine, or a guidance chip without this stuff.
And right now, isn't China the bottleneck for pretty much all of that?
Exactly.
Yeah.
China processes the vast majority of these minerals. Germany is terrified of that choke point.
Yeah.
If Beijing decides to tighten export controls, which they have threatened to do, German assembly lines just stop. So they go to Australia.
Because Australia has the rocks.
Australia has the rocks, but more importantly, Australia is a safe bet. It's a stable democracy, a Western ally. Think of it like an investment portfolio. For 20 years, Germany put all its retirement money into one high-growth, volatile stock called China Core. It paid off handsomely, but now that stock is crashing.
So they're panicked and buying boring index funds.
Precisely. Australia and the Gulf states are the boring, stable index funds. You might not get double-digit growth every year, but you won't lose your shirt if there's a political crisis. They are trying to hedge their exposure.
But this brings up the U.S. factor again. With President Trump in office, isn't this diversification also, I don't know, a signal to Washington?
A huge signal. The Trump administration has made it crystal clear. If you are too dependent on China, you are a security risk to the U.S. Germany wants to show Washington, look, we are cleaning up our supply chains. We are reliable. Please don't hit us with tariffs.
So it's insurance against Washington just as much as it is insurance against Beijing. Okay, so that's the macro picture. The government has a plan. Diversify. Get safe. But this leads us to our second theme, which I find even more interesting. It seems like the German companies, the ones actually making this stuff, didn't get the memo.
Or maybe they read it and threw it in their shredder. This is the central paradox of the German economy right now. You have a complete misalignment of incentives. The government wants de-risking, they want national security, but the companies, Volkswagen, BASF, Siemens, they're looking at their quarterly targets and saying, we cannot afford to leave China.
Let's drill down on Volkswagen. I mean, VW is practically the symbol of German industry. If they sneeze, the German economy catches a cold. What are they doing that's so contradictory?
Well, while the politicians are flying to Australia to find new partners, VW is doubling down on China. They've announced a strategy literally called China for China.
China for China.
It sounds like they're partitioning the company. In a way, they are. They are moving R&D into China. They are hiring thousands of Chinese engineers to build cars specifically for the Chinese consumer, using Chinese software, Chinese battery tech.
So they aren't shipping German engineering over there anymore?
No, they're adopting Chinese standards to survive.
Why go that far? I thought the whole point of German engineering was that it was, well, German. Superior.
And that's the hard truth they've had to accept. In the EV market, German engineering isn't superior anymore. And it's definitely not cost-effective. By localizing everything in China, VW claims they can cut production costs by 40%.
40%.
And speed up development by 30%.
40%. That's not a margin of error. That's a completely different business model.
Exactly. In the automotive world, that is the difference between life and death. If they tried to build those cars in Wolfsburg and ship them to Shanghai, they'd be priced out of the market instantly. They have to become Chinese to sell in China.
I have this analogy in my head. It's like the German government is the parent telling the kid Volkswagen to eat their vegetables. Diversify, it's healthy for your long-term future. But the kid knows that eating a candy bar gives them the quick sugar rush they need to win the sprint they're running right now.
That is a perfect way to put it. The government is optimizing for survival in 2035. The companies are optimizing for survival in 2026. And this clash gets really messy when we go back to those rare earth minerals.
Right, the Australian rocks.
The government says, buy processed lithium from Australia. It's safe. It aligns with our values. But here's the catch. Australian processed lithium is significantly more expensive than Chinese lithium.
And in a low-margin business, like mass-market cars, paying a premium for political safety is a very tough sell to shareholders.
It's the availability versus price problem. The government wants availability-guaranteed supply chains that won't break during a war. The companies care about price competitiveness, and unless the government steps in and pays the difference...
Through subsidies or something.
Through massive subsidies or tax breaks, yeah, the companies are going to keep buying the cheap Chinese stuff.
Which brings the U.S. back into the room. I've been reading about Project Volt. It sounds like a spy movie, but it's actually trade policy.
Project Volt is a cornerstone of the current U.S. administration's economic strategy. The U.S. is stockpiling critical minerals, literally hoarding them, to create a buffer against China. They're treating cobalt and lithium like strategic weapons, and they expect their allies, including Germany, to do the same.
So Germany's being squeezed. The U.S. is pressuring them to secure supply chains or face consequences. Their own government is pressuring them. But the companies are saying, if we do that, our costs explode and we go broke.
And Germany has a tradition of ordoliberalism, which is basically the state sets the rules but doesn't tell companies how to play the game.
Hands off.
Very hands-off. Unlike France, where the government loves to intervene, Germany usually waits for the market to decide. But in 2026, that approach is hitting a wall. The government might have to force companies to eat their vegetables, or the taxpayer is going to have to buy the vegetables for them.
It's a mess.
Yeah.
You have a breakup on one side, a tug of war on the other. But now let's zoom out to the thing that is keeping everyone awake at night. Theme number 3, the second China shock.
Right. And this is the macro trend that really explains why those German companies are so desperate to cut costs in the first place.
Most of our listeners probably remember the first China shock, early 2000s. China joins the WTO. Suddenly, Walmart is full of cheap goods. It hurt American factory workers in textiles and furniture, but it meant cheap T-shirts for everyone else.
Exactly. That was a shock to low-skilled manufacturing. Germany largely survived that one because, Germany didn't make plastic toys or cheap T-shirts. They made complex machinery, luxury cars, chemicals. They thought they were immune.
They were higher up the food chain.
They were way up the food chain. But the second China shock is a whole different animal. This time, China isn't selling cheap plastic. They are selling high-tech electric vehicles, advanced robotics, wind turbines, solar infrastructure.
They moved up the food chain.
They climbed the ladder, and now they are eating Germany's lunch.
They are attacking Germany's crown jewels.
Absolutely. China is now a direct competitor in the very industries that define the German economy. And because of the massive subsidies the Chinese government poured into these sectors for years, they have a glut of supply.
So they have too many cars and not enough buyers in China, so they just ship them to Europe.
Yes, and they ship them at prices that European manufacturers simply cannot match. This is what we call dumping in economics, but it's on a scale we've never seen for high-tech goods.
This sounds like a complete disaster scenario. But looking at the notes from the European Central Bank, the ECB, there's a weird, counterintuitive twist here.
There is a silver lining, but it's a cynical one. It's all about inflation.
Break that down for us. How does a flood of cheap Chinese EVs help the economy?
Well, think about the last few years. Europe has been battling high inflation. The cost of living went through the roof. Now, suddenly, you have this massive deflationary pressure coming from the East. Prices for cars, solar panels, and machinery are dropping because China is flooding the market.
So for the average person, this is actually good.
For the consumer, it's great. Your next car might be 20% cheaper. For the European Central Bank, it's also helpful. They've been raising interest rates trying to cool down prices.
And now China is doing the cooling for them.
Exactly. The central bankers are sitting in Frankfurt thinking, hey, we don't need to crash the economy with super high interest rates. The Chinese imports are keeping prices down for us.
So in a way, it creates a split reality.
It really does. If you work in a German auto factory, this is an existential crisis. Your job is on the line. But if you are a retiree looking to buy a cheap electric car or a central banker worried about the price of goods, this shock is actually solving your problem.
It's like, imagine a neighbor opens a store on your block selling luxury goods at half price. If you own the local shop, that's a disaster. You might go out of business.
Right.
But if you're just a neighbor who wants cheap stuff, it's the best day of your life.
That is the perfect way to visualize it. And this is why the European political response is so paralyzed. They want to protect their factories with tariffs and barriers, but they also secretly love the low inflation that these imports bring.
So where does this leave investors? We are called investment insight after all.
It creates a massive divergence in the market. We're seeing two Europes emerge. On one side, you have the policy sectors, defense, infrastructure, grid modernization. These areas are getting government money. They are part of that safety strategy. They are, insulated.
Yeah, the other side.
Traditional manufacturing. The companies exposed to that brutal price war with China, unless they can pivot like VW is trying to do by effectively becoming a Chinese company in China, they are facing serious margin compression. Their profits are going to get crushed.
So betting on the shield defense and infrastructure seems safer than betting on the sword, the traditional exporters, right now.
That's a colorful analogy, but I'd say it's accurate. The companies building the fortress are safe. The companies trying to go out and fight on the open field are in a lot of trouble.
All right, we've covered a massive amount of ground. Let's try to recap the three big takeaways before we sign off.
Sure. First, Germany is rewriting its entire foreign policy in real time. The old three-legged stool of Russian gas, U.S. security, and Chinese exports is gone.
And they are pivoting to the Gulf for energy and the Indo-Pacific for minerals to buy insurance against a volatile world.
Second, there is this massive internal fight. The government wants to de-risk and play it safe. The companies, especially the car makers, are addicted to the Chinese market and are doubling down just to survive, creating a huge conflict of interest. And third, the second China shock is hitting Europe. It's high-tech, it's threatening Germany's core industries, but ironically, it's helping to keep inflation low,
Right.
which puts the politicians in a real bind on whether to stop it or, just let it happen.
Which leads us to a final, slightly provocative thought to leave you with. We see companies like Volkswagen investing billions into China right now, building R&D centers, hiring engineers, transferring technology, all to save money today.
Right.
But you have to wonder, by teaching the competitor how to build better cars, are they just feeding the beast that will eventually eat them?
That is the multi-billion-dollar question. They are trading long-term intellectual property for short-term survival, and if they do get eaten, who pays the bill? Does the German government step in to bail them out because they are too big to fail?
And if they do, is that basically the taxpayer paying for the company's refusal to eat their vegetables 10 years ago?
History would suggest that's exactly what happens. Private profits, public losses.
Something to chew on. That's all for this deep dive into the German economic engine. We hope you feel a little smarter than you did about 20 minutes ago. Don't forget to subscribe and hit that like button. Thanks for listening.